Hello everyone. Today is April 14th, Friday. The stock market is closed now. In this video, we are going to be talking about market snapshot as a lot of macroeconomic data was published this week starting on Wednesday when the CPI number, Consumer Price Index, was published, followed by the PPI number, Producer Price Index, on Thursday, and today the retail sales numbers were published. And how the stock market has behaved, the current snapshot. Here I am looking into the US Bureau of Labor Statistics website, looking into the Consumer Price Index that was released for the month of March on April 12th, Wednesday, showing the CPI items rose up by 0.1% in March, but shelter increased and gasoline was down. So overall, basically, the measure in all categories, the inflation was up basically 5.6%. Major categories, it's at 5%, 12-month average CPI. In the food category, it's 4.5%. It quite a bit higher, but the energy component is down by 6.4% because, as you might have noticed, the gas price in last couple of weeks has been going down. And we can get more details how the charts are looking like. So if we click here, it will tell you basically the more details about in the less food section is only 1.5% CPI. The CPI attributes to this shelter, and it is all the the real estate transactions that are closed. But if you look into forward-looking numbers like Zillow numbers or other top shillings numbers, even the shelter components are moderating, indicating the economy is really the inflation is slowing down.
Siegel, who is back with us, and we're so glad to have you, Professor, on this day. You said a couple of weeks ago, quote, "I can't be optimistic until the Fed, shall we say, gets it," and there's no sign they do yet. How do you feel hearing these comments that we've gotten today and what you might hear in the days ahead?
Yeah, I mean, I believe the Fed has already done too much. I voiced that for the last 6 months, that the trajectory was way too high. By the way, speaking about the core, if you actually put real shelter prices in, I mean, from Apartment List, Zillow, or the Case-Shiller number, I've done the calculation. Core has been zero inflation for the last 4 to 5 months. So it really wipes out the core if you use real shelter prices instead of the, as we know, dramatically lagged prices that the Fed is using. So really, core is not a problem.
So now moving on, we are looking into the Producer Price Index. The numbers were published on Thursday. The market had a sell-off on Wednesday because people are still think the inflation is still strong, and Federal Reserve is going to raise interest rate in the upcoming FOMC meeting. But today, the PPI numbers were announced at the beginning of the trading starts. That's showing that the inflation final PPI number, it declined by 0.5% in March. All goods actually fell by 1%. Services declined by 0.3%. And you can get all the charts here. This is a month-to-month average. Pretty much all categories, total, the food, at the end, basically showing everything is down. Energy is down. So most of these categories showing that the PPI, which is a forward-looking indicator for the consumer sentiment, that the inflation is slowing down. Maybe Federal Reserve may not raise interest rate that aggressively. So market went up quite a bit on Thursday, both Dow Jones, S&P 500, and Nasdaq. And going forward, today, the I think the retail sales number came up, and retail sales number also came up, showing like in March, monthly sales of retail food and services are down by 1%, which was and February number were revised by 0.2%, and indicating maybe the consumers are not spending enough, and consumer sentiment, it might flip in a dime. So the market got a little bit nervous, and it sold off around noontime, and then recovered a little bit at the end of the trading time. So market is very jittery, basically, like what will happen. Jay Powell, the Fed chairman, what is he going to be doing in this upcoming meeting? So we can see like that there is a website in CME group. It's called Fed Watch Tools, in which you could see, say, as of today, on May 3rd, what is the probability? So current Fed rates at 4.75 to 5%. So if they raise 5 basis point, 5% to 5.25%, there is a 83.4% probability that Fed is going to raise by 25 basis points. Few days ago, this probability was lower, maybe like high 60s. On Thursday, it went up to like in mid 70s, but today it's picked up. Similarly, if you look forward in June, what might happen? So there could be another rate hikes after these 25 basis points in June meeting. That there could be another 25 points rate hikes, but at a low probability of 13.4%. So if you keep moving down, so in the month of July, it will remain same. That the as if like the Fed fund rate will be peak at 5% or 5.2%, maybe another 8.6%, very low probability of like half a quarter basis points going on in like September. Similar, maybe if you look back in December, then you can see okay that Fed they could be cutting rates. So the highest was at 5.25%. Now it's like it's like 35% probability that maybe Fed is going to be cutting rates and continue to keep cutting rates at different probability, for 32.3%. It's all because after this Silicon Valley Bank and Signature Bank, all these like defaults, the credit situation has become very tight, and the economy is going to be slowing down, and Federal Reserve, they cannot keep hiking interest rate very aggressively. Otherwise, the recession is going to follow. Even like very well-known bankers like Jamie Dimons, they said like the banking industry, they are not out of the woods. So there could be like other kind of like bank defaults and other kind of like under credit events. So Fed basically they are like put it in a corner, or they'll be forced to cut like interest rate. It's suddenly basically like if the market like the economy deteriorates in terms of like the labor market. I can also show you. I think the labor numbers came up. Last it was like 236,000 unemployment rose on the meeting on April 4th. Although the unemployment rates remained at 3.6%, unemployment rates numbers rose by 236,000, meaning more people are coming to the labor pool, and more people are getting, like, unemployed. And Federal Reserve, they want to keep, raising interest rate. They want to have more people to be unemployed, so that economy, the inflation will slow down. So it will be very, interesting what happens in next 2-3 weeks till May 3rd, what the Federal Reserve is going to do, and let's see how the market will behave in the meantime.
They should have stopped. They shouldn't have raised last time. It looks like they're going to raise again and make an announcement of a pause. I really hope Austin Goolsbee makes a dissent, because there has not been a dissent for over a year at the Fed. Groupthink has reigned, I think, to the detriment of monetary policy and the American economy. And I would like to see another voice actually make a dissent at the meeting. So
if they
I am awaiting that.
Professor, if they raise in a few weeks' time, what happens to stocks?
Well, I think it depends. I mean, we still have, what, 3 weeks to go of data. I mean, I really think, again, what happened to the banking system and what I see in data on lending falling off the cliff really portends a much bigger decline in economic activity. I am shocked that no one at the Fed has actually cited the reduction in lending that has occurred almost the most in 75 years, actually. We know M2 liquidity last year fell by the most in 85 years. It's falling again this year. The squeeze on liquidity is much greater, believe it or not, on the money supply than we even saw during 2007, 2008. Now, I'm not claiming we're going to have that, because that froze the entire banking system. But what we saw with SVB and the lending standards, I think the Fed should absolutely not raise. What does this mean? The probability of recession has gone up. Listen, I said for the last 2 months, I'm not really optimistic about stock prices in 2023. I hope they go up. They might.
You were, though. But you were. Until not that long ago. You thought we were going to have a big run.
They'll finally get it. So we'll have a recession. Suppose we have a recession. Earnings are down 10%, 12%. You give me a number for a year and a half. Then they're going to boom again, 2024, 2025. And I think those are going to be great years. If you look over the trough, I'm still saying don't, even though it might be rough over the next 3-6 months, unless you're very tactical and very short term. I mean, I'm not a seller.
Economic data is going to be available in next 2 weeks, and I'm going to be publishing Courtest numbers. I hope you enjoyed the video. Thank you very much, and have a nice weekend. Talk to you again, and if you like this video, please do subscribe it. Thank you.